Good morning. It is President's Day, Monday, February 16th, and the markets are closed today. So instead of giving you, we're going to give you a market update, but we're going to talk a little bit about projections and what we might see, because there's been some pretty exciting news lately. So let's really dig in and see where we could go from here. So mortgage rates are falling and are now approaching some of the lowest levels we've seen in the past few years. And a lot of people are asking why. So the biggest driver isn't the Fed cutting rates, but it's the bond markets. Mortgage rates typically track the 10-year Treasury, and that yield has been dropping as investors increasingly believe economic growth may slow and future inflation could moderate. So when investors move money into bonds for safety, those yields fall, and then we can see mortgage rates follow. We're also seeing a ton of volatility in the markets across a lot of different asset classes, and that pushes capital into safer investments like bonds. So let's take a look here at the numbers. You know, the average fix is nearing 6% now, which is great. That is much lower than what we've seen in quite some time. 30-year FHA and VA are approaching the mid fives, which again is fantastic. And so let's talk about those recent low levels. This is a 5-year chart of mortgage rates. So obviously just outside of COVID, and then everything went straight up. And then we started to try to see some downs, but we just keep going back and forth, back and forth. So in the last 3 years, starting right here, you know, we've touched this 6% line just a couple times, and here we are again back. So hopefully, but you can see this here is shallowing off. It's not a steep decline, it's steady. So hopefully we can go like this and eventually get back down into the fives. And you can see here, this is just a 1-year chart, so it looks a lot more drastic because everything was hanging out a little higher. So this is a good thing, and we are seeing what we want to see as, again, these capital in the markets are kind of being shifted around. So gold, for example, is hovering around historic highs. Same with silver. You know, this is a strong demand it's reflecting for safe haven assets. The Dow Jones hit a record high as well recently. So there's a lot of action happening. And then meanwhile, Bitcoin has pulled back significantly. It's trading in the upper 60,000s right now. So they've had a huge sharp correction. So when money is rotating out of those risky assets like crypto and into bonds and precious metals, that tends to push the mortgage rates lower. So that's a huge thing to watch. Now, the Federal Reserve, the most recent meeting was at the end of January. They did not cut rates. They stayed still. We talked about the 10-year Treasury too. So let's take a look at that. Chart's not loading, but you can see here 4.0. It's been 4.2. So as the money is moving back in, this moves down. If we see a 3 here, then we'll probably start seeing rates under 6% as an average. So we're getting close. Things are starting to happen really well. But back to the Fed. Next Fed meeting is scheduled for March 17th, and then a decision being on March 18th. So we'll watch closely for any updated projections and signals about potential rate cuts later this year. But there's also really no there's also major uncertainty surrounding the leadership at the Fed. There's expectations that there's going to be a new chair. He's already been nominated, so now we got to wait to be nominated. The pick was made, but we have to that person has to get confirmed. And then leadership changes can shift policy expectations. And then markets, this is the most important thing, markets price in any kind of expectations immediately, long before anything actually happens. So depending on, talk about Fed leadership, anything talk of a more dovish or hawkish chair can move mortgage rates significantly in either direction. Now, a quick definition of what does that mean, dovish and hawkish. A hawkish Fed prefers higher interest rates, tighter monetary policy, slower borrowing and spending, stronger currency, lower inflation as the top priority. With these kind of people, you usually see the rates a little on the higher side. Dovish Fed, you usually see a little bit lower rates because they prefer lower rates, easier borrowing condition, stimulating the economy, more tolerance for inflation, supporting employment and markets. So lots of changes that will come. And again, the markets will price them in immediately once they see something to anticipate. For home buyers and people who want to refinance, homeowners, lower rates are creating real opportunities right now. So buyers are gaining purchasing power. Sellers are seeing increased demand. I'm seeing, especially over the last week or so, multiple offers happening. Even though it's 2 or 3 offers, it's multiple offers. And so things are selling a little quicker here lately, especially with these rates coming down. So homeowners, if you have rates in the high 6s or above, you might benefit, likely, very much so, benefit from refinancing right now. If you're an adjustable loan or a temporary buy down that's nearing a reset, you should definitely start reviewing your options so that you can avoid those higher payments that are impending for you. So rates don't move in straight lines, and that's something to just keep our eyes on here. They can reverse quickly if inflation data surprises or any economic conditions change. So very, very important. Now, if you want a personalized analysis of your situation, whether you're looking to buy, refinance, do some investments, or just planning, please reach out to us here at Clubhouse Lending. We'll help you understand your options so you can make the smartest move and not just guess based on headlines. Have a great week, everyone, and we look forward to some exciting times in real estate coming ahead.